America's stock market is flashing two red signals. The last time both appeared together was in 1999, right before the dot-com crash that wiped out trillions. And today, both signals are even worse. So, here is the real question. When Wall Street catches a cold, does Dalal Street get pneumonia? Most people will give you opinions. But today, we are going to look at the data. And the answer is not what you think. Hi, this is Kamal. Before we go into the data and the details, do not forget to subscribe, like, and comment because it would help reach maximum number of investors. So, let's start with America. Two indicators, both screaming danger. First, the CAPE ratio, which measures long term earnings. Its average is 17.17. In 1999, it hit 44. Today, it is around 40, the second highest in history. And now, if we go to the second indicator, which is the Buffett Indicator, Warren Buffett himself said that when this number hits 200%, you are playing with fire. Today, it stands at 219%. Two indicators, one message, and the message is America's market is sitting on a powder keg. Now, let's come to India because this is where things change. The Nifty PE ratio is around 19.6 with a long term average of 20 to 21. Not expensive, not cheap, just fair value. Here is the key insight. Every time Nifty crossed a PE of 22, the next 3-year returns turned negative. Today, we are below that level. Even more interesting, Nifty is at the 34th percentile, meaning it has been more expensive 66% of the time. India is not in a bubble, it is stable. But here is the number that should worry you: 1.2 lakh crore rupees. That is how much FIIs have pulled out in 2026 alone. March was the worst year ever, with 1.14 lakh crore rupees sold in a single month. At peak panic, FIIs were selling 1000 crore rupees every hour. Why? The reasons being oil jumped to $119, the rupee weakened near 95, and the US bonds became more attractive. Suddenly, India didn't look like the best bet. The risk is not India's fundamentals. The risk is global panic because panic does not read balance sheets. But here is what most people are missing. India is changing and it is changing for better. In 2025, DIIs invested 7.44 lakh crore rupees, while FIIs sold just 1.66 lakh crore rupees. Domestic money is now stronger than foreign money. 10 years ago, 25,000 crores of selling could crash the market. Today, India absorbs that in weeks. This is not the old India. This is a market driven from within. So, here is the bottom line: America is overvalued and fragile. A correction is not a question, but the question is when the correction will take place. India, on the other side, is stable, reasonably valued, and nowhere close to 1999. But India does not exist in isolation. If Wall Street fails or falls, India will feel the shock. So don't ask, will India crash? Ask instead, how much damage will come from outside? Watch these three things: US valuations, FIF flows, and crude oil, because these signals will tell you what is coming before the market does. If you like this video, do not forget to subscribe, comment, and like. Thank you.